Good morning, everybody. This is Mayuresh Joshi, Head of Equity Research at William O'Neill, and I'm very pleased to have all of you as we discuss the Indian banking scenario, the measures that RBI has taken in terms of the liquidity push, and measures for the banking and the financial industry as a whole. We'll have a look in terms of how global bankers are facing at this point of time, and therefore, I think the impact in terms of the overall pandemic in terms of the moratoriums created and the effect in terms of asset quality issues raised over the next few quarters. As a clear disclaimer, this is only for educational purposes. All the discussions that we'll have related to stocks are by no means recommendations either to buy or sell, but just information in terms of how this industry is poised and how this industry looks at this point of time. So this is what the agenda is. We're discussing a lot more of the agenda as well. So the next 40-45 minutes, we'll go full throttle in terms of how the industry is, the dynamics of this industry, and the different issues and aspects faced by the industry at this point of time. But before we go to the Indian scenario, what has happened on the global scale and in expectations of the lockdown pressures because of the pandemic have clearly caused huge upheaval for the banking and the financial industry as a whole. Now, this is the first industry that gets hit either side. Demand contraction, asset quality issues, credit loss provisions needed to be done, and therefore, I think the ability for all the banks to withstand and take risk really depends in terms of the financial health that each bank carries through. But it also has the inherent risk of the domino effect that if a multitude of banks start going bust, the entire system might actually crumble down. Therefore, the viability and health of the financial system, specifically the liquidity run through banks and the financial support created for business organizations worldwide, is extremely critical. I'll speak in terms about the money supply dynamics. I'll also speak in terms of the central bank action, specifically from an Indian context on what RBI has done as measures to boost the banking system as a whole and measures to boost the economy as a whole. And banking is required, and we've always heard the phrase, it is the lifeblood or the life system that any economy works on. Because it's ultimately the money supply that flows through the entire economy that helps the economy be robust, helps the economy have good financial health from an overall macro balance sheet perspective, and therefore having a viable banking system, ensuring liquidity is apt in the system at any given point of time, depending on the economic conditions, and ensuring that adequate risk has been undertaken or underwritten with the presumptions of certain loans going default or defaulting because of natural business conditions. That does take one into the tide as well. So on the global scene first, and how the banks have performed, and this is the loan loss provision that a lot of these bankers have provided. So you can see banks across Europe, banks across the United States having huge amounts of loan loss provisioning actually being undertaken at this point of time. Why is it needed? I think very obvious in terms of the large unknown at this point of time on how businesses will recover in terms of lockdown pressures being felt by the global economy, how demand recovery will ultimately lead to liquidity flowing through the system in a consistent and a calibrated manner as well, and therefore the effect in terms of the end businesses, the effect in terms of the entire cyclical chain that goes through, and the ultimate effect in terms of the lending that a lot of banks have done, along with how deposits might actually grow for the banks as well. I think all these factors play a very, very important and a critical role in defining our entire money supply system. So you must have heard all the terms M1, M2, M3. And that is very, very essential in terms of having a base for the system as a whole. So tremendous amount of loan loss provisions done. HSBC, for example, $3 billion odd dollars. Barclays, $2.65 billion. Standard Chartered close to $956 million. And Santander has the largest at $4.2 billion. This is where we are positioned from a Nifty Bank perspective. Obviously, we fell off the cliff once the pandemic started, before the pandemic started. So around this point of time, till the middle of February, when things were all okay, at least in terms of news flow on the global scale as far as the pandemic was concerned. And as things started rolling out in terms of the multitude effect that it can actually spread globally, and the equity market started taking it on their chin. And again, I think the risk off which came through in terms of the large unknown and the fall in markets, because banks have a huge correlation to the economy as a whole, because banks have also the largest weightage in terms of the index movement as a whole, and three, because of the inherent pressures that the street felt that banks will be the hit the most in terms of the financial and the economic deleveraging that we might go through over the next few months or quarters. I think the reaction was obvious that came through over the next few weeks until the end of March, as the index hit an all-time low during this crisis period, an intraday low of 7,520 odd. The bank index also corrected nearly by half. Obviously, had a period of respite, and the last few weeks, specifically the last week in particular, has been very, very encouraging, not just for the markets, but for high beta correlated sectors, including banks. So now, as you see, as I'm moving my cursor, we've clearly broken through most of the daily moving averages. So the green one here is the 21-day moving average. The red one is the 100, and the green one and the red one, the pink one is the 100, and the red one is the 50 DMA. So the intermittent moving averages have all been broken through with very, very good volumes. I think the next hurdle is the 200 DMA, but that's far, far away, at least at this point of time. I think the markets will now try to gauge, also looking at how numbers have panned out for Q4, and assuming that the quarter to come, that is Q1 of this financial year, because of the lockdown pressures being far more evident for almost 2.5 months, and that will be felt on the banking industry as a whole, along with the moratoriums that have got introduced. That is going to create a huge amount of upheaval, as we understand. Now, if I go through the industry as a whole, the Indian banking system is huge. So if you probably compare that on a global scale, and even though we are underpenetrated in terms of a large amount of our rural population or diaspora, not still having adequate access to banking facilities, adequate access to organized credit facilities, I think what the Indian banking system has done and delivered, along with the regulatory moves of creating small payment banks, of creating microfinance institutions. And again, I think the way that we are going digitally and the access to data, with the confidence coming through that your money is safe in banks, it's safe to transact if you use the right modes and mediums. The banking system can have huge penetration in unbanked areas. That is what the entire ideation is. But as a system and as an industry, I think we are huge when it comes to numbers. So I'll just lay down numbers for you. They're very, very interesting. I've not put that on the slide. This is what I'm going to do. So the Indian banking system has 16 to 17 public sector banks. They'll obviously shrink because of the mergers and acquisitions that is expected to go through over the next few months. Around 2021 private sector banks, 40 to 45 foreign sector banks, around 50 regional rural banks, 1,500 urban cooperative banks, and almost in excess of 90 or 1,000 rural cooperative banks. And this is the data that I got from the banker's site, and this was updated as on October 2019. So figures might have changed here and there a little bit, but the audited figures are close in terms of the deposit growth that I'm talking about. Now, the deposits from FY 08 to FY19, which is the audited figures, have grown at a CAGR of 11%. Until the end of February 2020, the deposits for our economy as a whole were at a staggering US $1.9 trillion, which is almost 140 lakh crores in terms of Indian not rupees. Now, as I said, within the different subsegments that we cater to, because there are different societies that the banks need to cater to, the microfinance sector has actually grown at a huge pace over the last 8 to 10 years. And the equity funding for the microfinance sector stood at almost $2 billion odd dollars by the end of FY19. We witnessed a lot of innovation banking models, as I said, small payment banks, on-tap licenses that RBI has given to the industry as a whole. What we've seen in terms of various payment models, the digital modes that I kept talking about. And therefore, I think the measures that the central government and RBI is taking for the industry as a whole is huge. Now, the recent developments that have taken place in February 2020, a couple of months back before the lockdown started, the Cabinet Committee on Economic Affairs has given an approval for the process of recapitalization of rural regional banks. That is, it will extend for 1 more year. And for those regional rural banks that are unable to maintain their capital to risk weighted average ratio, the CRAR as we call it, because they need to maintain the capital in terms of the perceived risk that the business probably assumes, in terms of their lending parameters, in terms of their underwriting rules for different business segments that they provide loans to. So the minimal capital that they need to maintain against the risk-weighted average, and every asset class that they probably cater to or lend to has a certain weightage assigned to it in terms of the risk that that asset class carries. So they need to carry the right amount of capital to risk averages in terms of the lending that they do to particular sectors. Actually, so they've kept that to 9%. Another interesting fact was that the Department of Post in October 2019 had launched the mobile banking facility for all post office saving accounts of core banking solutions in the post office department itself. Now, post office is one of the most prominently working organizations, and since banking facilities partially were allowed to go through there, this was a very important mode, because post offices cater to a lot of areas, a lot of regional, a lot of rural areas where banks probably are not present at this point of time, or even if they are present, I think the confidence that the post office has within even the minutest of the smallest of towns is pretty huge. The deposits, the Jandan account, which the central government had initiated, the 15 billion odd dollars in terms of deposits, 1.06 lakh crores by the end of 2019, and 37.5 crore accounts were registered, which is itself a feat if you presume the banking industry globally. Yes, one might very well argue that the asset quality pressures are also equally huge at this point of time. The NPAs, as at the end of 2019, were pretty large. They also had a large recovery, because that's what a lot of banks were actually doing over the last few quarters as well. So they did manage to recover around 50, in excess of 50 billion odd dollars in the last 4 years. And the record within that 50 billion, I think almost one third of that came in FY19 itself. Just a brief in terms of 2018, the government of India also launched the India Post Payments Bank, as I mentioned, and it has opened branches across 650 districts across the country for the objective of financial inclusion. Now, the last union budget also made the systems fully automated in terms of the GST refund module and the e-way bills. They've also announced recapitalization for public sector banks, which is the need of the hour. Another interesting facts, as on the As per the audited numbers on 2019 year end, the debit and credit card issued in the country were 925 million and 47 million respectively. In terms of the foreign exchange reserves, it is kept on going higher and higher, and it's almost 480 billion odd dollars in terms of reserves at this point of time. So again, I think the purpose in terms of doing the stats is the kind of is the industry size itself, and it's pretty huge. And the way we've managed to go and tide through crisis is because of our strong regulatory actions and our strong controls that we've got in terms of the industry as a whole, in terms of regulations as a whole. And yes, as I'm saying again and again, I think the asset quality pressures are profound. But again, I think the measures that have been adopted and the need that goes through in terms of qualitative credit lending that the system still needs, startups that still need credit funding, entrepreneurs that need credit funding, and even businesses that need credit funding to thrive and grow is extremely critical. So, with that scenario, I think the credit growth scenario, which is the latest, which we picked up from the RBI data, is that retail credit has grown at an average of 16 odd percent over the last 12 months. Now, within the retail credit itself, home loans did slow down. The growth in credit cards or personal lending, as we call it, whether it's for your personal purposes or your credit cards that have got issued, that has come down to 5%, and consumer durable loans have slipped. Again, I think this is an aberration because what you've probably seen in terms of the lockdown pressures, people not able to move out, so on and so forth. I think that is extremely critical in terms of understanding on how the system has evolved right now. But over a longer period of time, I think retail credit, as I've mentioned in my first line, has grown at a humongous pace. And that is what has led to tremendous growth in terms of advances that the banking system has undergone. The industrial credit, on the other hand, has only grown timidly by 1.7% in April. Again, a large element of sectors have degrown in the last 2 months, chemicals and cement being the exceptions. But MSME loans have declined, and therefore, I think the RBI and the central government, which has come through in terms of the packages that have got announced, in terms of the automatic approvals, for example, for MSME loans for 3 lakh crores, in terms of the RBI measures that they have done as a last mile funding for NBFCs, 50,000 odd crores in terms of the LTRO package that have got announced, equally split 25,000 for the better rated ones, 25,000 for the non rated ones as well. So that gives a lifeline in terms of funding that is essential, and that is a critical lifeline in terms of lending support to NBFCs. Apart from the MSME announcement that the central government has done through the package, and which the banks will obviously cater through, we'll obviously come to the moratoriums part. But what has largely happened in terms of lending for a lot of sectors at play, specifically in terms of lending against paper. So only qualitative paper would have qualified for substantial amount of lending through the banking system as a whole. And it was very, very obvious that better rated corporates, which had a high rating in terms of either AAA or AA, could have access to the bond markets in terms of having their credit limit sanctioned. But now, with the government initiation and with the government intervention as well, what has actually gone through in terms of lending against unrated paper, lower rated paper, without any substantial haircut, I think that's extremely critical and essential for ensuring that the liquidity and the banking system supply, which I'll briefly touch upon in terms of M1, M2, M3, gets carried on in a very consistent and robust manner as well. All these factors might ensure that growth starts coming back, though I think the April month was an aberration, as I said. Before I head to NBFCs, what has the RBI done over the last few policy measures that they've announced. And it's again very, very critical to understand that. So first, I think the repo rate. The repo rate has been cut quite substantially. The reverse repo rate has also been cut quite substantially in terms of providing ample liquidity that the system probably needs at this point of time. As I said, the RBI has undertaken LTRO. What is LTRO? It's long-term repo operations. So RBI will keep on buying from the banks itself so that they can have sufficient amount of liquidity. And that liquidity the banks can start deploying with lower rates, both on the repo that the RBI has done and transmitted. And a lot of bankers have actually started transmitting that through the system, which means lower rates of lending. It obviously also means, because banks are also profitable institutions, that they will lower the deposit rates, which they have done. And the benchmarking in terms of lending to the MCLR and the deposit rates being recalibrated as well means that the NIMs or the spreads or the profit margins that the banks simply enjoy remain at constant levels or improve. RBI has also announced that CRR would be reduced. So as of March 28, there are almost 1,50,000 odd crores in terms of liquidity infusion allowed in the system. They've also announced the ease of working capital financing. So in this case, I think the lenders are allowed to lend to recalculate the drawing power by reducing margins or by reassessing the entire working capital cycle for the borrowers. Again, from the lender's perspective, the RBI made it very, very clear that it would not result in an asset quality or an asset classification downgrade, because that is extremely critical. If an asset starts getting downgraded, you need to provide more depending on the bucket that you're probably putting it through. But once you've started downgrading that asset, you need to provide for that. And the standard asset exposures need to get mandated over the next few quarters. And that excess provisioning will eat into the cash flows or the ultimate profitability of banks. There's also working capital interest moratorium that got announced. And the MSF, which is the marginal standing facility, has been increased to 3% of the statutory liquid ratio till June 30th. Now, this measure, as I said, will allow comfort to the banking system to avail an additional 1,37,000 crores of liquidity under the liquidity adjustment facility window in terms of stress, in times of stress. So as clearly, I think the MSF has been increased to 3% of SLR, which is the statutory liquidity ratio, till June 30th. And that allows 1,37,000 of excess liquidity in the liquidity adjustment facility window. So I think all these facilities have been announced by the RBI as well, which is extremely critical to monitor. And therefore, I think we have adequate amount of liquidity that is there in the system at this point of time. I think it's a matter of time as banks start underwriting, assuming credit risk assessments that they do individually across sectors. And as demand slowly and steadily starts inching and coming back, we'll start inching towards the double-digit growth that we probably are looking at. So the credit growth on overall scale, even before the pandemic started, and the non-agricultural credit growth still remained in higher single digits. The presumption is that we should start seeing some element of improvement, even if we've seen degrowth, as I've shown in the last slide, for the last 2 months, specifically to come back very, very strongly. Now, the NBFC exposure as a percentage of the total credit is obviously around 8 odd percent, and NBFCs need money. And the basic support that NBFCs have within the entire banking financial system as a whole is largely dependent from the banks as a source of borrowings. The better rated NBFCs, as I said, with better credit standing facilities, have access to the bond markets. They have access to better quality commercial paper that they can subscribe to. And they also have access in terms of accessibility to other modes of investments, either in the form of NCDs, perpetual debentures, or even preference shares. Because I think the quality of their balance sheet probably ensures that investors probably might back them up, even in torrid market or economic market conditions, which are worse off as we are seeing or witnessing at this point of time. So this is a snapshot in terms of the contingency provisions that a lot of bankers on the Indian context have done. So HDFC Bank has done a cumulative floating plus contingency provision of 1,500 and 3,000 odd crores. So they've got 45,000 crores, 4,500 odd crores in terms of provisioning created either through the cumulative or the contingency provision route. And this is created in terms of the unknowns that the banking industry might face. So as the term suggests, it is contingency. So anything going wrong, it's something like a contingent liability, that if that liability comes on our face, do we have enough capital or liquidity or support to take care of that liability at hand? So the lending that all these banks do to a lot of sectors, to a lot of vulnerable sectors, to a lot of sectors which might feel the pinch and the heat in terms of slower demand recovery and ultimately slower cash flows affecting their interest repayments on their loans, whether it's long-term loans that they've probably drawn or working capital loans that they've probably taken up. I think all these measures prove as a buffer to the system as a whole. In similar breadth, Axis Bank has contingency provisions of 3,000 crores, and that includes 10% provisioning on all overdue accounts, irrespective of moratorium. So, what the bankers have done as a safety provision, as a safety norm, apart from the moratoriums that have been granted or not, they have actually created contingency pools. And the cumulative contingency pool, like for HDFC Bank, has 4,500 crores, for Axis lies at 6,000 crores. And the need is far greater because I think the lending of Axis Bank towards corporates, towards mid corporates, is far larger compared to HDFC Bank, which still has a huge say in terms of advances growth coming through the retail sector. ICICI Bank, COVID related provisions of 2,730 odd crores, out of which 600 corresponding to half of the total provisions on overdue accounts. Kotak Bank, 650 odd crores. Bandhan Bank, almost 700 odd crores. And this is over and above the 310 buffer created. And again, for all these banks, and specifically Bandhan Bank, though they have taken over Group, and there is reasonable amount of diversification as far as their lending is concerned, with the acquisition of Group and the housing finance segment as a whole, microfinance still rules the roost. And how the collection efficiencies are, specifically in stressful times like this, is extremely critical. So Bandhan Bank apparently has also created, or has stated, that almost 70% of its accounts have been classified under moratorium. Ujjivan and Equitas, which are the small payment banks, are also diversifying their business model, but still predominantly stay into the microfinance business module, have almost 85-90% in terms of the moratorium that is not announced. RBL Bank, COVID related provisions of 150 crores. And again, a large part of RBL Bank's growth, as I said, within the first slide that I discussed on the advances growth, in the retail sphere itself has been more to do with the credit card growth, and that has seen, or that is largely unsecured, which means that there is no security against the loans that are given, either against personal loans or credit card loans, and the chances of default are pretty high on both these segments. And therefore, I think what the bank has done is 100% provisioning on the entire credit card book, which is almost 15-16% of the overall loan book for the bank itself. SBI announced results yesterday at COVID-related provisions of 930 odd crores, which is far lower. And again, I think in terms of the overall slippages and the provisioning that they've done, has been extremely prudent from a bank's perspective. In fact, SBI's PCR is one of the highest in the industry as a whole, and that stands around 83.5% as we speak, which is phenomenal. And that again is expected because I think they are not willing to take risks, or they're provided prudently, which again gives us the comfort in terms of the prudent provisioning that these bankers do in lieu of the regulatory actions and the mandated regulatory actions that are required. Now, the moratoriums, and what is moratorium, right? And moratorium is an extension in terms of the dues that are expected from the end industries to whom loans have been given, and an extension in terms of those loans because of the financial difficulties that a lot of these business segments might face in the pandemic that we are going through at this point of time. So we are all going through lockdowns, we are all going through business shutdowns at this point of time. Because there is no business, at this point of time, and there is no money supply that is actively moving around because of the shutdowns that we've witnessed. The obvious need in terms of providing moratoriums or relief in terms of interest payments against the loans that they have availed of has become a necessity at this point of time. RBI has, in fact, given a further extension of 3 months, and therefore, I think the street was a little bit perturbed in terms of the defaults that might go through. What if these businesses are not able to repay? What if the demand cycle takes longer than one expects? What if these businesses, specifically MSMEs, the smaller businesses, the SMEs, to whom a large portion of credit that has got lent either through long term loans, either through working capital loans, and what if the security that they're provided against these loans is not enough to cover the entire liability that is on hand, and the other creditors that they also probably need to in terms of the normal business assignments? I think this is what the concerns were getting played out for the industry as a whole. And therefore, I think the need that RBI felt and the government felt to create moratoriums, which was an obviously to support business cycles. But from the banking industry as a whole, whether these moratoriums will go bust or whether the loan payments will not happen to the exact T, or all these payments will not come through even after the moratorium period with the extended version is over with and businesses are not able to repay, is what the measures a lot of these bankers have taken in terms of providing, in terms of the moratoriums that they've actually created in terms of the pandemic effect. So how the reality will pan out, I think the next few quarters and the numbers thereof will tell us. But I think the assumptions largely are at this point of time, after assessing their books and all these moratoriums that you're probably seeing, on how the bankers themselves feel, on how much should go into the moratorium at this point of time, how much further can go in the next few months as well, as they take an assessment of the real situation across industries and across clients that they probably speak to, and how much additional or adequate provisioning is required in case of a certain percentage of this actually not coming back, if one presumes that to happen over the next few quarters. So, as I said, for Bandhan Bank, almost 77%, as an example, is under moratorium. 100% of the microfinance book, which is almost 69% of the loan book, 13% of the mortgage book, and 35% of the SME book has gone under moratorium. SBI and yesterday's statement said that 21.8% avail moratorium. And out of the entire advances book that SBI has, that's almost 23 odd percent. HDFC Bank, I think that is one of the better ones in terms of the moratorium, because largely I think the portion that gets dominated for HDFC Bank is retail, and that is at higher single digits, 8 to 9% if I'm not mistaken, and 95% of the customers in moratorium were not at default. ICICI Bank, Axis Bank, almost 28 to 30% in moratorium. Kotak Bank, 26%. And for Kotak Bank, I think the moratorium in retail is higher in value terms than wholesale. So this is one important point that one needs to take into account as well. For the small payment bankers, as I said, Equitas, Ujjivan, almost 85-90%. And therefore, I think if you probably look at the sphere in terms of the entire banking industry as a whole, the dispensation that RBI has given a lot of customers who have opted for these moratoriums in economic distressful times in terms of the financial stress or the financial deleveraging that a lot of their businesses are facing is extremely critical. But I think the bankers have done their part in terms of providing for the same as well. And that provisioning might take or might have taken the sheen off in terms of reported bottom line numbers. They might take a further sheen off, as I said, in terms of the reported Q1 numbers. But that is a prudent measure that all the bankers have adopted at this point of time. And in my opinion, again, I think this is one thing that holds us apart when you probably look at how our performance of our bankers have been from a financial health perspective, from a balance sheet perspective, compared to a lot of the global bankers at play at this point of time. Yes, I mentioned in my opening slide on how the global bankers' loan loss provisions also are at this point of time. But I think the proactiveness in terms of how we react to the system as a whole is far more prudent. Now, before I just share how the banking stocks have performed from a results perspective, And mind you me, again, there are no recommendations either buy or sell, only factual data in terms of how results are, and factual data on how charts look at this point of time for these stocks as a whole. But before that, I think I'll just briefly touch upon, as I said, on what money supply was and why money supply is very, very important for the banking sector as a whole. So I think the entire concept in terms of understanding money supply and what economists believe of money supply is that as money revolves around the system, obviously with ballpoint marks taken in terms of the interest rates that the regulators announce, and looking at the interest rates, the kind of money flow that probably increases or decreases in the system, how the public and the private counterparts are adjusting through this money supply, the impacts in terms of the inflationary nature, and the RBI regulatory impact in terms of interest rate or policy decision making is extremely critical. So any increase in money supply in simple layman terms, right? If money supply gets increased into the system, it lowers interest rates because it's normal economic theory of demand supply, and it generates more investment because I think a lot more liquidity is available into the system in the hands of either end customers, which are either entrepreneurs, retail customers, and drives up demand, both in terms of industrial output actually getting increased and demand getting increased in terms of end users or the end retail public as well. Because businesses start showing traction, ordering a lot of raw materials for their business consumption, and in terms of creating ultimate end products, the need for labor increases, and therefore the entire system in terms of the cyclicality that the money supply goes through in the system starts extrapolating and gets increased at a fast pace across different sectors of the economy as well. And the exact opposite happens as contraction happens in terms of interest rates going higher, lending probably decreasing, contraction in terms of the output or utilization levels, and therefore the end user demand as well. So it's been a key in terms of driving a lot of regulatory or central banker decisions, and that obviously depends in terms of which cycle we are, both from a macroeconomic perspective and the business cycle that the economy is going through. So I think it's very, very important that if you probably need to read any articles related to this, are very, very interesting articles on the entire money supply concept. So there's Irving Fisher's quantity theory of money. So if anybody of you is interested in reading a lot more in terms of the evolvement of money supply, the Irving Fisher's theory or quantitative theory of money is extremely important, and there is quite critical elements that he's probably put through in that. You can also go through the Indian banking regulation sites where money supply has been defined in a very, very robust fashion as well. Now, money supply, I'll quickly touch upon that before we proceed further as well. So, you've all heard these terms M0, M1, M2, M3, right? So, all these types of classifications reflect the different types of liquidity and the different types of the end use of money it has in the system itself. So, M0, M1 is normally in economic parlance called as narrow money, and that includes all the coins, all the notes that we probably use, and that entire usage of all of us using those notes or coins in the system itself, and which remain in circulation, which move from one party person to the other, from one business to the other, and which is obviously in cash and which can be exchanged in cash and can be convertible in cash, or is MO or M1 as we call it. Now, M2, in addition to F1, which is your coins and banknotes, also includes short-term time deposits. So all the deposits that you've got in banks, which are easily redeemable, which are encashable at any point of time, your overnight money market instruments, MIBOR as we call it, right? The Mumbai Interbank O rate, which determines the overnight rate. So the short-term liquidity instruments that you've got, either in bond markets, which can easily be converted into cash. So M2 is the notes and the banks and the instruments that you've got in terms of either short-term deposits that can easily get converted into cash, or your short-term deposits that you've got in terms of ultra short liquidity funds or ultra short government bonds, which can easily get converted into cash if the need arises for any business or individual to probably adopt for that. So M2 is an extension in terms of M1, with these instruments also getting included. M3, again, I think M3 is a money zero maturity. It includes financial assets with zero maturity. So I think it really depends in terms of the regulators issuing bonds or bonds which are at a discount in terms of the face value at this point of time. But again, I think the factors that are more important at this point of time is M0, M1, M2 in terms of circulation. It is again typically recorded by the central bankers. Therefore, I said, I think apart from the Irving Fisher theory in terms of the quantitative theory of money, the regulator side and our own RBI side has a lot of publications that you've got in terms of MO, M1, M2, and even M3, which is a little bit off at this point of time. But I think this is how money supply is looked at and calibrated as well when we're probably talking about the system as a whole. So I thought that it's pertinent to discuss this important aspect as well. So again, as I said, in terms of the banking stocks, no recommendations here, just factual representation in terms of the numbers that they've reported and how they are placed at this point of time in the overall market context. So for HDFC Bank, in Q4, the NII grew 16%. The asset quality, if you probably talk about X moratorium was 1.26. If you include the moratorium on the gross NPA side that they have done, and around 8 to 9%, which have probably availed the moratorium facilities, 1.36. So not much of a difference out there. The provision coverage for this quarter stood at 96, but overall, I think the PCR, including floating provisions, stand in the higher 70s, which is very, very phenomenal for the bank as well. NIMs have stood at 4.3%. Retail wholesale 51.49, but you look specifically in terms of Q4, and the inching up of retail deposits has been even higher because the bank is very, very cognizant in terms of strict underwriting rules. By underwriting, I mean in terms of who to lend, in what proportion to lend, on which sectors to lend, and which sub-segments within those segments to lend at a particular given point of time. So it's been very, very consistent. If you look at the top right chart in terms of the asset quality pressures, it's not got accentuated because of the strong business model that the banks have carried through. Obviously, the SME, MSME book, and some banks have a larger exposure there. They will continue to underperform, as I said, both for the moratoriums availed by these industries as a whole, and in general for how the entire segment has probably or is expected to perform as well. And this is how the bank probably looks from a chartical perspective at this point of time. Yes, again, as I said, the entire fall would have got replicated on how the bank index has performed. But still, I think it is far more consistent when you probably look at this index. And all of this is available in terms of our product itself. So our product has outstanding features in terms of fundamentals, in terms of how the technicals are played out, details in terms of fundamental analysis, the detailed automated processes that we done at the back end in terms of analyzing huge amount of data on the fundamental scale, which probably gives you the checklist in terms of this entire parameters that we probably got in terms of the overall master score, which depends on a lot of fundamental factors as plays the EPS strength, which is the ultimate earnings guiding tool for any stock and sector in general, the buyer demand and how the buyer demand is in terms of demand supply, which gets played out, the group rank in terms of comparing a lot of fundamental factors with all its peers at this point of time, the price strength in terms of how the price strength is. And again, I think typically the manual bias is also taken out because a lot of chart formations in terms of determining your entry point into a stock is done by the software or our automated AI process itself, which makes it very, very convenient for the end user to go through. So the bank has done exceptionally well. Yes, these are periods. Quarter 4 of last year, Q1 of this year will be exceptional in terms of reporting of numbers. But the consistency is probably there in terms of earnings that have what we got reported. From a technical perspective, it has taken, as I said, the green line is the 21 DMA, the red line is the 50 DMA, the black one is the 200 DMA. So it's reclaimed as 21 and 50 with very, very strong volumes. So the strong rebound that we've seen over the last few weeks and months has been phenomenal, and all banks have probably delivered in line with what the index has delivered, and the bank index also in terms of its movement overall compared to the overall index vis-a-vis as well. Kotak Bank, Q4, impressive NII growth on a year-on-year basis. Quarter on quarter, again, expected to be muted because the last 10-15 days were obviously strict lockdown measures that got introduced. And though banks were functioning at that point of time, I think the limited access or the people's access to limited banking facilities because of lockdown actually accentuated or ensure that the growth on a quarter-on-quarter basis probably remains very, very subdued. The contingency provision that I mentioned, 650 odd crores, around 26-27% by value terms at the account level have availed. The interesting aspect here is that moratorium in retail in value terms is far higher than wholesale. So this is one aspect that I said that needs to be taken into account as well. The bank has a large number of MSMEs under the 25 crore ticket size. So I think the management expects that the 3 lakh stimulus with government guarantee will ensure growth. Let's see how that entire scenario pans out. Therefore, I think the next couple of quarters, Q1, Q2 specifically, are going to be extremely critical as far as the entire industry is concerned. Deposits have grown at a very, very reasonable pace. And therefore, even from a banking perspective, how advances grow and how deposits grow are extremely critical to ensure that their financial health is taken care of. So we all hear the terms. They've got a very, very strong liability franchise. It really depends in terms of how their growth probably gets based on. And because deposit rates will go down, how are they able to calibrate the deposit growth itself? Because in uncertain times like these, I think the alternate investment tools that a lot of investors at the end level have are very, very limited in terms of the risk that they're willing to partake. CASA stood at 80%, and therefore I think assuming the credit deposit growth is extremely critical. Deposits also for the system have to grow at a very, very reasonable pace to ensure that they can have adequate support in terms of credit growth. They also need to have reasonable amount of capital adequacy. So all the terms that we keep on hearing on business channels, whether they have adequate capital at their behest or their disposal to ensure that their balance sheet grows at a reasonable pace that they've been doing in the previous few quarters or years is extremely critical. Therefore, I think when public sector banks lagged behind is that their capital ratios or the capital adequacy as we call it, the CET1 ratios, the core capital adequacy ratios had fallen abysmally. They had to do a lot of provisioning in terms of asset quality pressures witnessed, and they also need to do a lot of priority sector lending, which the government mandates them to do. There are also a lot of defaults. There were a lot of write-offs in terms of farm loans, for example, being written off. And therefore, I think the MSME lending, the end user lending that all these PSU banks do, have eroded a lot of their capital at their disposal. Therefore, I think the need to pump in capital, as I discussed in my opening remarks, the need to further pump in capital, what needed in terms of LIC, for example, taking a stake in IDPI, for example, in terms of providing more, in terms of all these asset quality pressures for the priority sector lending selectively, say farm loans, for example, does take a toll in terms of both their profitability and ultimately, I think this profitability does eat into their capital adequacy as well. Apart from that, the normal business cycle ensures that they need to provide 15% as a first measure in terms of the standard loans that have got defaulted. Provide a further 30 more and 35% more in terms of tranches over the next few quarters across buckets as the loans start getting get defaulted into different buckets, and the provision is required on that as well. Therefore, I think what you probably saw of erosion happening in higher single digits for a lot of these PSU banks, the mandation in terms of mergers required so that the capital adequacies will get boosted. There will be a lot of cost synergies. There will be a lot of revenue synergies. and a lot of synergies in terms of servicing the end user customers. I think that was very much the need of the hour. Therefore, I think all these parameters that we talk about, I think Kotak Mahindra Bank and a lot of these private sector banks, capital adequacy remains extremely robust for them, which means that when time comes in terms of demand recovery, they probably are very robustly placed, better placed in terms of the public sector counterparts to take advantage, both through the capital that they've got in terms of balance sheet growth that is required in terms of the overall advances growth that these banks can cater and undertake, as well as ensuring, because of the digital prowess that they've got, to probably provide far more in terms of digital innovations and faster decision making processes to roll out initiatives, products, services than the PSUs. But the PSUs have caught up over the last few weeks and months and quarters in terms of digital rollouts. SBI, for example, I think Bank of Baroda, for example, you look at any of the public sector banks, I think the digital rollouts have been pretty huge and pretty effective as well. So the public sector banks are getting there in terms of competing with the private parts, counterparts. But again, I think on a lot of these parameters, as I said, I think the private sectors are counterparts are largely better placed on a relative basis. Recoveries, as I said, for a lot of asset quality pressures that these bankers faced were the focal point over the last few quarters. And the figures that I mentioned in terms of the recoveries that these banks have done phenomenally in FY19 on the audited numbers were huge. And that itself lays a base in terms of how the entire thinking is now, both in terms of underwriting new loans as well as recovering new loans, old loans that were probably given to ensure the financial health of the system as a whole. So again, I think reasonable performance as far as the bank has delivered, consistent performance. Again, the provisioning that has been there or mandated because of the COVID related issues has been profound for a lot of these bankers. But again, the consistency has been there in terms of reported numbers on the asset quality front, in terms of NII growth, in terms of advances, in terms of the strong capital advocacy that it carries, and in terms of the recent promoter stake sale that has also got mandated. So I think there has been a lot of user interest, institution interest at the end of all of it, and that is extremely critical in terms of the end performance that the bank probably delivers, because it's ultimately a lot of these institutional investors demand and interest that lies in these banking stocks that determine the overall trend that a lot of retail investors will follow. And therefore, if you probably look at this part of the product itself, the number of funds has actually gone up. So I think there is sufficient enough of demand in terms of the huge stake dilution that the promoter is going through. But there are buyers in the market who are probably wanting a pie of this bank, which is shown through the number of funds actually going higher for the bank as a whole. And therefore, I think what you've probably seen in terms of institutional ownership for these banks, or even in the case of HDFC Bank, being on consistent basis or being consistently high, is very evident from the strong numbers that they probably carry quarter after quarter, year after year. Axis Bank and the capital adequacy, if you probably see at the right hand side, is extremely high. So if you talk about the CET1 that I spoke about, at the end of this quarter, it was at 13.31. The additional 81 capital plus tier 2 that we talked about, and the overall capital adequacy at 17.53 is the largest the bank has so far at point of time. So they raised sufficient amount of capital a couple of quarters, a quarter back, and therefore I think what you probably saw in terms of reported capital adequacy numbers, I think it's extremely important. Now within this segment itself, if you probably look at the subordinate debt, it's 17,700 odd crores on Axis's balance sheets with no maturity till FY21. So they've got a reasonable amount of buffer that they've got created in terms of their assets under play, the liabilities under play, and the subordinate debt of 17,500. The maturity is still way away, which means it's got enough buffer time to probably look at the entire cash flow dynamics as well. Now, the retail loan book, which is almost 53, 55 odd percent of its overall loan book, and out of that, I think 80% is secure. So that's a very good sign. Because if there is security against the retail loan book, which is more than half of its overall loan book, 50, 53, 55, as I said, I think that gives enough comfort in terms of the system as a whole, in terms of recoveries, if anything goes bust. Now, for the moratorium itself, 10 to 12% of the customers and 25% of their advances have got opted for the moratorium itself. It hasn't given any moratorium to any NBFCs or housing finance companies, and it would not be providing any future guidance. And that is the best part, I think. So I think it's wait and watch for the bankers as well, as we are speaking in this time period, in this quarter, on how the situation has evolved. Again, the extension in terms of moratoriums and how the entire scenario will play out, on how many further institutions probably opt out for that. The margins were stable, as I said. The recalibration happens in terms of both lending and deposit rates. Therefore, I think the NIMs or spreads actually hold out. So, like in the case of HDFC Bank, the overall NIMs are holding steady at 3.5%. In fact, SBI, which I'll go through as well, also had steady names at 3.14%. The NII growth, again, quarter on quarter softer, but year on year has grown very, very strongly. And their provisioning has gone up primarily because of the COVID provisions, as we discussed in the slides related to the bank's overall provisioning. And it was mandated because it is an adequate measure, as I said, that a lot of these bankers have undertaken or partaken at this point of time. So again, I think the earnings hit, and therefore I think the EPS strength, if one may ask, or the group rank will turn out to be very, very poor because it's a huge hit from an earnings perspective that these banks have taken, primarily because of the excess provisioning of COVID that they've got created, primarily because of the sudden lockdown that got accentuated in terms of advances growth slowing down, in terms of the overall loan book actually deaccelerating for the particular number of days and for the quarter in play, and therefore I think creating an impact on both these aspects, along with accentuated pressures created on the moratoriums and the normal business provisions that were anyway required, creating a huge hit on the bottom line. So I think these are aberrations in abnormal times. This will further get accentuated, as I said, in Q1, because the lockdown pressures were even more profound over the last 2 months, and therefore I think the underlying in terms of all these parameters have to be taken with a pinch of salt. So again, for the index as a whole, I think this stock has undertaken or reclaimed its key short-term moving averages. How the entire scenario plan spans out from a macroeconomic perspective, from an index perspective, will determine the growth of these stocks as well. Now, there has been some churn that has happened in terms of fund movement as well. Therefore, I think we need to monitor all these aspects very, very clearly, both from a macro perspective, the bankers' actions that we'll probably understand as Q1 numbers are announced, which will happen in a month's time because we are already at June 7th. By July 7th, in a month's time, the Q1 numbers will come through, which are obviously expected to be worse off and far worse off in terms of reported numbers on Q4. Therefore, I think one needs to take this with a pinch of salt, understand the scenario that the industry is going through, understand the macro impact in terms of certain banking stocks, which will feel the pinch even harder compared to a lot of the other uh, sector related stocks. So maybe the impact for FMCG stocks, maybe the impact for a lot of the consumer discretionary in terms of retail oriented stocks which still operated, a lot of industries on the rural side which could open operations and start moving out things in a more faster and robust fashion. I think the collection efforts for bankers because of lockdowns also under stress, the disbursal of new loans happened at a very, very tepid pace. Therefore, I think one needs to understand the larger picture when it probably comes to Q1 numbers. But this is where it is, and one, as I said, needs to take and understand both the macro and the micro elements at play when it comes to the banking industry and the banking stocks in general. ICICI Bank, and again, I think if you probably look at how the NII growth has been, robust growth on a year-on-year basis. Margins, again, stable performance because of the recalibration that they've done. They stood at 3.9 odd percent. The loan book grew reasonably on a year-on-year basis. Quarter on quarter, again, very difficult to monitor because it would have been slowing because of the lockdown pressures getting accentuated. Within the advances growth as on March 31st, retail, as I said, has been a prominent hunting ground for all these bankers, and that has grown at a huge pace on a comparative scale at 63.5%. And the absolute size in terms of the book is almost 4,100 odd crores. SMEs and corporate and the other books, conscious effort in terms of slower underwriting, like we've seen for the other bankers as well, and very, very obvious because they need to be very, very cognizant of the fact in terms of what might go bust and therefore I think selective lending is the need of the hour at this point of time. Retail portfolio, again 53% of the overall portfolio, as I mentioned here. I think there has been a clear increase by 1.3%, even on a quarter-on-quarter basis, as far as the retail portion is concerned, because on December it was almost 52 odd percent. So when you look at the asset quality trend, the GNPS in absolute terms has obviously gone down. Now there has been an impact in terms of classification, and the impact of classification on these loans would have been 18 odd bips, which the bank has given on their presentation for the quarter involved. So asset quality pressures obviously on a relative scale going down, but the number of clients, as I said, 28 to 30% for Axis and ICICI Bank opting out for the moratorium. So I think one really needs to understand in greater detail as Q1 numbers will come through, is how the entire segment will probably go through as well. Again, I think within the 80 unsecured retail book, 85% is uh, towards the salaried again. So again, there is expectations of stable cash flows. Though we've heard certain elements, we are not sure in terms of the authentic figures, in terms of the unemployment stats. So this is one figure that we need to probably also look at. So yes, I think the conscious effort in terms of underwriting, in terms of the moratoriums, and in terms of the provisioning that these bankers have done, uh, the bank again has, as I said, 28 to 2,800 odd crores of COVID provisioning, primarily towards retail, which is a large portion. And again, I think the contingency provisions is around 1,500 odd crores, and 1,200 will go through overdue accounts. So apart from normal provisioning that they've done for normal accounts, the excess provisioning also acts as a buffer. And again, I think Q1 numbers will be important to monitor on how many more have opted for, or how much more provisioning was probably needed in terms of the business cycle that a lot of these subsectors, specifically of the SME and the corporate and the other book, are going through at this point of time. So this is how it is looking compared to the others as well. I think a similar performance, earnings far and more consistent. Yes, the kind of strength, as I said, is profound, because I think the quarter growth on a quarter-on-quarter comparison is obviously a little bit on the lower side. The price strength obviously will be poor because of this fall that we've probably seen, and the retake of the key moving averages, at least the short-term key moving averages, is a supportive factor. How it plays out is going to be critical in terms of Q1 numbers stacking up, in terms of the macroeconomic developments happening over the next few weeks and months as well. SBI came out with numbers yesterday, and if you probably look at how their entire performance has been, again, gross NPS, net NPS improving in relative terms, but what you probably seen in terms of moratoriums, better performance compared even with the private parts. So I think 21% have availed of that. In terms of the overall slippages, the overall slippages have also come down quite significantly for the bank as a whole. The loan growth was reasonable, even on a quarter-on-quarter basis. Single digits, the expectations of moving to higher single digits as the economy improves was something that the management felt. Again, I think they had a wages revision, so almost 400 odd crores in that term itself. There was a divergence in terms of FY19 numbers, but last quarter almost 11,400 odd crores in terms of the divergence has got accounted for in the December quarter. And again, I think the kind of provisioning that they've done for IBC, almost 5,800 odd crores, is extremely critical. Now, they've put out their presentation, and what they've clearly mentioned out in terms of the outstanding dues across sectors and the exposures that they've got. I think the year-on-year growth, apart from retail loans and home loans, I think they've been very, very conscious in terms of a lot of industries that they are probably giving loans to. So the underwriting has been very, very strong. And therefore, I think the need of the hour in terms of how credit growth will play out, in terms of the excess liquidity that we have in the system, the money supply that we probably discussed, is extremely critical and extremely pertinent. Again, the sectors that have got impacted and the outstanding that they've got, I think they've got clearly mentioned out there in terms of the individual sectors. So the power sector, they've got a huge lending on that front as well. Aviation, heavy industries or infrastructure, including iron and steel, textiles, petroleum, petrochemicals. I think these sectors are something that you need to take cognizant about, but also aviation and tourism, because those are the sectors that have felt the heat the most. But again, I think the bank probably sounds far more confident. They have provided, as I said, the PCR for SBI stands at 84.6, which is one of the largest for the industry as a whole. So prudent measures being followed. So here we are, and this is how the SBI probably looks from a chartical perspective. Reasonable amount of NII growth. What you probably saw from an earnings perspective has been far more consistent. Again, aberrations, as I said, one needs to take this with a pinch of salt in terms of what we've seen this. But again, like the other banking stocks, with a strong upsurge in the bank index itself, the reclaim that they've done of the short key moving averages at 21 and the 50 DMA has been very, very prominent. What what goes through in terms of the entire scenario in quarter one numbers is going to be extremely critical. What goes through in terms of the macro factors, regulatory actions, both from the RBI side, as well as what central bank actions happen from the financial industry as a whole is going to be very, very prominent as well. I did not cover microfinance companies, but as I said, I think a lot of these microfinance, small payment banks, huge moratoriums, as I've discussed in my opening remarks, performance has been reasonable. They are expecting calibrated growth to take place. The collection efficiency, specifically on the rural and semi-rural side, specifically on the microfinance loans, are expected to come back. The collection efficiency till March was very, very robust. How this entire few months have been in terms of fresh disbursements, which have been very, very carefully been done over the last few weeks by a lot of these end user institutions, and how the recoveries have been, specifically, as I said, through the collection efficiency ratios, are going to be very, very critical in terms of their overall growth and their earnings perspective. Secondly, I think the capital adequacy and how much of the disbursements actually happen across other business segments as well, because they've also been diversifying across different segments, including commercial vehicle financing, including tractor financing, for example. What are the chances in terms of loan growth prospects? How the loan book has moved? Though the substantial contribution in terms of the overall advances book still remains skewed towards the microfinance book, and even within microfinance, are they seeing sufficient trends on both these aspects of strong disbursal growth and strong collection efficiency on earlier loans remains extremely critical to be seen. Valuations extremely attractive for PSUs, for these small payment banks, but there is also the inherent risk that the street probably believes that this book might be under tremendous amount of stress. Therefore, I think the valuations have remained attractive, but whether they are conducive enough for an aggressive entry point, I think that one needs to see based on all these factors. Private sector valuations have come off significantly since their peak valuations of February 2020, 3 months back that we are discussing. And again, for obvious reasons that we've all seen and what the industry is going through. So, what critical elements happen for the industry as a whole over the next few weeks, months, how Q1 results stack up, what developments happen from an end user perspective, how developments happen from a macroeconomic perspective, and how the economic recovery takes place for the economy and for different segments of our economy as a whole, which will ultimately lead to credit or the banking system credit moving at a reasonable pace with the minimal defaults. Money supply again expected to start, as I discussed, in terms of MO, M1, M2, M3, happening at a reasonable pace through the economy and coming back to normalization levels, what we've seen a few years back. I think that will lead to supernormal cycle for the banking sector as a whole. RBI policies obviously will change as the business cycle improves, but the system is extremely critical, as I said, and therefore all these aspects that I discussed today in the webinar remain extremely, extremely pertinent. I'll take some questions. I'll take a couple of minutes for you to stack up any questions on the chat window, and I'll be more than happy to answer any of the questions that you have. So you can put in your questions if you've got. More than happy to answer that. So I don't see any question. Anyway, so if you got anything on this, you can write into on our Facebook page. You can write into our marketing team as well. Got anything? I think any of you will be more than happy to answer that. So thank you so much for attending this webinar. Hope it was informative. I enjoyed it. Thank you very much as well. You take care. Be safe.